This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Bob Sahota, thanks very much for coming on Talk Your Book. Really appreciate you giving us some of your time. I thought it might be a good place to start with a little bit about Revolution Asset Management and what you guys look to invest in.
Thank you, Chris, for the opportunity to come on Talk Your Book. I appreciate it. Revolution Asset Management is a firm that myself and two other business partners established some 2.5 years ago. We focus on Australia and New Zealand private debt. So the private debt markets, insofar as an asset class, has been not very well understood. It's been quite an opaque asset class, but hopefully in the next little while, I'll be able to shed some light onto what are the opportunities in the space. We feel as though it's a really exciting place for people to invest for stability, for income, and the ability to get a very good return through a very volatile period.
Maybe talk us a little bit through the history of private debt in Australia. I know post GFC there were some changes that APRA introduced, which really changed the landscape for, I guess, private debt and debt delivered by the banks. Do you want to talk us through what happened post GFC and why that created some opportunities?
So private debt in Australia is really in its infancy, mainly as a result of the fact that the global financial crisis was pretty kind on the Australian banks compared to the peers in the US and European markets. So in Europe and the US, the banks had to actually rapidly change tack by increasing their capital, reducing their risk-weighted assets, and that really ushered in the opportunity for private capital and private debt to come in and take the void. On the other hand, in Australia, after the GFC, we had banks that went on their merry way because they maintained their AA credit ratings. And really up until probably 2018, we're really focused on more like revenue and really building market share. But what happened with APRA and changes in global bank regulations is the fact that things started to become more about return on equity. So rationing of capital meant the banks couldn't act as asset managers anymore, i.e. being the asset managers in lending to corporate Australia and different parts of their private debt book, and then funding themselves through their own wholesale and deposit funding. But really they started looking at whether they, on the one hand, do more mortgages, which attract very little capital, or then act in other parts of private debt where the impost is a lot higher on capital charges. So that means that our market is really starting to develop for the opportunity side in unregulated capital, such as Revolution Asset Management.
And am I right that in America, a lot of loans that businesses get are from the big pension funds?
Yep, so very much institutional investors are very well established in the US and in Europe. And quite often you'll have banks who will come in and maybe underwrite deals or provide the revolving credit lines, but a lot of the term funding is now done with these private debt managers on a sort of buy and hold basis. We're starting to see some activity in that space with a handful of private debt managers in this country, but I would say there's a very infant market and an opportunity that really is at the beginning of the journey rather than the mature phase.
And what types of opportunities are you seeing now that you're finding it interesting?
So with our own strategy at Revolution Asset Management, we focus on really 3 different asset classes within the private debt market. So first and foremost, we provide funding to large-scale private equity acquisitions. So these are really large firms that have been acquired generally off the listed markets and listed equity markets, like Healthscope Hospital that was acquired by Brookfield. Arnott's Biscuits is an example that was listed or owned by Campbell's, is now owned by a private equity firm, KKR. Household names like MYOB, largest provider of accounting software, the biggest global provider of cancer treatment being Genesis Care, largest provider of infrastructure services, Ventia. All these companies have been now subject to private equity ownership. And what we do is with other co-lenders and other banks, provide the senior secured debt for those acquisitions. The second part of what we do is asset-backed securities. So rather than us individually going out and lending for mortgages, credit cards, personal loans, or auto loans, we will back the more established players in that space, like the Latitudes, the Flexi Groups, the Peppers of the world, Bluestone, insofar as we provide them the finance to go out and do what they do, and we get a very handsome return for those. And the very last bit is real estate lending, but we don't do any construction or development lending. We look for the cash flow of the underlying tenants to really be able to service our loans rather than purely the valuation. So across these three sectors, we're aiming to deliver investors with a core philosophy of capital preservation, being the core of what we do, in delivering a return north of 400 to 500 over in terms of sort of 4 to 5% sort of yields for that private debt and secured debt strategy.
And so if you talk through, say, the first two of those strategies, the debt for private equity roll-ups or buyouts, what sort of returns do you get? What sort of duration is that debt on an average sort of basis?
Yeah, so we're basically lending again as a senior secured lender. So for that, the term of these loans is usually 5 to 7 years, but they're fully prepayable. So generally, private equity is not looking to hold them in a normal world for any more than about 3 or 4 years, when they extract the value and then either put it back into the listed market or sell it on to a trade buyer or another private equity firm. So that's the duration of kind of the investment. Where is the pricing? I would say pre-COVID, the pricing was anywhere in the context of 4.5% to 5.5% yields. More recently, we've seen an increase in those as the illiquidity premium has grown through the COVID dislocation. So we're now seeing yields north of 6% for a senior secured position in these acquisitions. On the asset-backed security side, I would say the opportunity is probably even more attractive, as there is very few players that can actually do private lending to these non-bank originators.
And what sort of percentage can you see those sort of yields go up to for the Latitude or these sort of financial services products?
So look, there's a continuum of risk return that you can tap in private markets. We are very deliberate in focusing on the point of the risk return spectrum that we're still focused very much on capital preservation. So if you're out there lending to property development companies that are going out to do very speculative new developments, you would be demanding a much higher risk return. So that is not what our core focus is. We are more established to really get a laser focus on, getting the through the cycle kind of 4 to 5% kind of yields. But you can get more yield, but I think the higher the yield, the more that you go away from, capital preservation being the core, and that's not our core philosophy.
Have you provided any debt to any of the buy now, pay later type operators?
No, we have not. So we are typically focused on the more established, the people that have tapped the capital markets on a repeat issuance basis. So we're probably less focused on the early stage startup buy now, pay later guys. They're probably more of a sexy equity story than what you want to be able to lend to. And again, we kind of feel like if we do our job, it should be a fairly boring ride with us. We kind of give you a nice stable income for that defensive part of your allocation, and you can leave your equity allocation to do the more sexy fintech stuff.
And what do people often get wrong when they're looking at debt deals?
Well, the newer market for private debt, and there's been a lot of people looking to establish private debt here in Australia as a result of this opportunity that a lot of people have identified. I guess the issue here is making sure you understand one thing. Your discipline on what you say no to will determine whether you can deliver what's on the tin and what you've promised your investors. What do I mean by that? You can only make the decision to lend to a company once. You don't have the luxury of trading out of that position should you change your mind. It's not a liquid market. So we do a lot of work up front to make sure that we understand the risks, that we understand the downsides. So unlike the equity guys always looking for upside, we're looking for what happens in a recession, such as what we've got now. be able to say hand on heart through this period, can this company pay us back? And it's only when it ticks all the boxes on all the particular risks that we've identified will we then choose to go out and lend them the money. And what we've found is through the portfolio and how we've constructed it is we've shied away from the pro-cyclical sectors. So we're not in retail, tourism, hospitality, oil and gas or mining or commodities or property development that are more front-end cyclical businesses. We're more into the steady state, recession-proof businesses such as the one I mentioned.
And I know you've got a lot of institutional money, but also some wholesale money as well from private investors. I guess a lot of banks have been slashing their dividends now, and a lot of private investors are finding that bank shares are so highly correlated with their own residential home, and they're looking for some more non-correlated assets that'll pay a dividend. Is that one of the driving forces why a lot of people are coming into this private debt market?
Absolutely, Chris. So the traction that we're getting is very much that, you can get diversified away from this high concentration to banking and financials. So whether you're invested in equities or in the broader liquid fixed income markets, very difficult for you not to have a concentration to, almost all roads lead to the banks and finance. So for us, we can offer not only diversification away from that core sector, but also the fact that you're supporting businesses in other sectors, but be able to then get a much better income, stable income, as I've said a number of times through our discussion, in these sorts of areas. Who is that applicable to? Our product doesn't appeal to retail purely, but certainly as a wholesale investor, a high net worth, or indeed more recently, we've had a lot of traction with top end of town superannuation and pension funds here in Australia, where they are looking for genuine shy away from traditional bond market allocation to private debt as a genuine diversification play, and also for that key income component.
You mentioned the bond market there. It's a market that's obviously enormous and dwarfs the equity market in size. But in terms of price discovery, we've now got yield curve control, and the Australian bond market and the Japanese bond market and the Federal Reserve are talking about it being something they may implement down the track. Do you think there's a potential that investors do move away from that as they feel it's a market that no longer has price discovery, and will that be a tailwind for the private debt market as well?
Yeah, well, I think in the past, people had obviously had an allocation for bonds, and we've all studied finance, and the negative correlation of bonds and equities was always something that we studied. As everything's become more correlated, and you've got more of a control on yield curves, and you approach that zero, even negative rates, fixed income as an asset class, it's certainly fixed, but there's no income left, and downside protection. How much lower can it go? Can you really earn that yield or that kick if things continue to get worse when you're already at all-time lows? So I think that is a huge tailwind for where we can not only drive a credit spread for what we do, but because of the lack of competition in this market, so there's only really a handful of scale players in the private debt markets in Australia and New Zealand, where we can still demand a very good rate of return that we're charging, our borrowers to be able to provide a pretty good rate of return with very low volatility. Importantly, on a secured basis at the top end of the capital structure is getting a lot of traction and becoming quite compelling.
Well, you said you didn't view your business as in the sexy end of the market. I think you managed to make it sound very sexy, Bob. So thanks very much for coming on, and appreciate you giving us your time.
Thank you, Chris. Appreciate the opportunity.
Thanks, mate.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.